Okay, so I'm going to get started. I'm going to mute everybody and feel free to include any questions that you have in the chat box, and we'll go from there. As I go, as questions come up, feel free, send them, and we'll try to get everything addressed and hope everyone gets some great value out of tonight. And thank you all for attending. So let me switch. I'm going to go to a screen share and so tonight wanted to cover real estate investor tax issues. And again, thank you everyone for joining me. A little bit about myself. I'm a real estate investor and money lender and more importantly, tax reduction strategist. I like to call myself licensed CPA for 20 years. I've worked in public accounting, spent some time in industry as a CFO of a large national electrical contractor. So pretty much been on both sides of the table and able to really work with my clients. And so I think those of you that know me, others that don't, I'll be more than happy to discuss things further, but don't want to bore you with everything about me. So I'm going to move on. Here's a quick disclaimer. Everything presented tonight's more of the general nature. Please don't sue me. If something comes up tonight that's been presented, it was more of a general nature, and down the road, if a transaction comes up, I always advise clients to consult with me and we can go from there because a situation we discussed tonight may sound like it may apply to you, but I wouldn't use it as tax advice or tax opinion. Real estate's risky by nature. Those of you that are already in it, I think, know that. Win, lose, or break even. But until we have a professional relationship, everything is general tonight. So there's my legalese and my disclaimer. Appreciate everyone for joining. So some of the topics I wanted to cover tonight were tax deductions and good bookkeeping best practices for new investors, taxability of investment real estate owned personally versus through an LLC or an S corporation, 1031 exchanges historically have been a great tool for wealth creation and preservation. And then some of the possible changes with the tax law and the new administration in 2021 and beyond, and where I see things happening based on experience and some of the proposals that are out there right now. But first, one of the questions I get from a lot of investors is they're an investor. And those of you that know me and have talked with me, I really try to dive into what you're doing, because I think those of us that think we're investors, you might be a house flipper really in this area, what I like to call your active and ordinary income. We also have investors that are more of just the buy and hold landlords. They'll buy a rental property, put a tenant in it, and just collect rent. It's fantastic. Then there's also what I really call more of that investor portfolio slash speculator type investor that, let's say, is going to buy a vacant piece of property, hoping that the neighborhood is going to go at a future date. And the biggest thing is I always run into is real estate. It could be a home, a flip, a rental, speculative, because we're going to level the property. It's really all sticks and bricks and dirt, but where it comes on your tax return is really the biggest thing. And my job is really to work with my clients and those of you to be able to try to figure out which of these buckets it's going to go into. Those of you that are flippers or just buying houses, building houses, more on the construction side, are really going to fall into this category. Wholesalers that are on the call tonight. And that's really where the biggest question is. Problem with that you're really running into more of the higher tax rates, and then also the self-employment tax. And then I always like to say, think of that your real estate as an inventoried asset, just like the clothing store shirts on the rack. That's what that real estate is. You might be adding value to it by improving it or renovating it. The biggest question is with active activities such as a flip activity, it's going to be something that a 1031 exchange is not available to you because it's really just ordinary income. You're not going to depreciate the property. You're going to acquire that property and then add value to it, such as the improvements, your additional cost. That's going to be your cost. And then you're going to sell it maybe in the retail market to another investor somewhere. You're going to end up selling that property. And the biggest question is, you start a property in September of 2020, incur a substantial amount of costs, and then sell it in January 2021. Where do all those numbers fall? Your costs are really carried into the next year, generally as an inventory of that activity, and then you're going to use that against your sales price. So let's say you buy the property for $100,000, you put 50 in renovations, and you sell it today for 200. Your deduction just on that transaction is really none for 2020, and then 150 this year, with 200 for your sales price, less your 100 of purchase and your 50 of improvement. So the big thing there, that $50,000 gain would be subject to self-employment tax and also income tax. Depending on other factors, you're going to be somewhere in these tax rates. So proper planning, sometimes we can minimize or reduce those. And in that case, from an active ordinary person, your losses on the deal are not limited. So that same deal, let's say you put 150 into it, and something happens in the market, and you sell that property and for 100,000, you've lost 50,000. You're going to be able to take that $50,000 loss against other income. For those of you that maybe one spouse is working and the other is a full-time real estate person, those losses are great to offset your W-2 income. So really opens the opportunity. Those losses, though, could also offset your W-2 income from your management company. So as your investment portfolio and activities really start to get more complicated, how you structure things can have advantages. So more on the buy and hold. I think those of you that are familiar with rentals, this is on the rental side, real traditional Schedule E. On the entity return, those of you that are familiar, then the biggest thing is passive income and also passive losses. So for those of you that you're a W-2 investor, working a regular job, you might have a good W-2 job, you buy a few rental properties, and it's generating some losses from your improvements to that property, or your depreciation. Hopefully it's positively cash flowing, but you're going to end up with losses. The biggest thing is your rental income and loss is going to be ordinary, but you're going to be subject to limitations on that. And we'll get into that further. Quite often I get questions on real estate professional status that can be utilized. But on the rental income loss side, so for instance, let's just say the husband's a full-time real estate landlord. You're generating $30,000 in losses on your rental activities. His wife makes $75,000, and in that case, they would be able to deduct 25,000 of their losses because they're not limited. If they make over 100,000, those passive losses become limited, and if they make in excess of 150, those losses are zero that they get to deduct. So let's say the husband is losing every year $35,000 on his 25 property rental portfolio because of depreciation and other deductions, and the wife makes $175,000 a year on a W-2, they're going to get their deductions, but it's going to be what's called a passive loss carry forward. That's really going to come into play because in their case, the question how aggressive they go with depreciation or some of their improvements is somewhat of an irrelevant point, because they have activities that, yes, we can make that loss greater, but they're not going to get a benefit. Those of you that find yourself in this situation, you're not going to lose those losses. You just don't get them today. When you sell a property, though, if you haven't aggressively depreciated it, your basis will be higher. In theory, your gain will be lower because you've depreciated it. And then when you do sell that activity, let's say next year, that same investor with the $35,000 passive loss carry forward sells a property at a $75,000 gain, that will free up those passive losses. So that's more what I call that W-2 landlord that, you know, has some rental properties, is making a substantial W-2, wanting to get into investment, and really looking at planning for those. When they sell properties to them, they could do a 1031, but they may not need to. They might want the gain on the sale to utilize some of their passive losses. So it's really with proper planning, you can minimize your taxable income if I know the facts. I like to work with clients more throughout the year if they have a property that they're looking to buy or sell. I actually had a call with a client today. They're closing on a property they're selling next week. They contacted me and at least able to walk through the transaction and some of the nuances there. There's more that we can do before you get to the closing table, whether you're buying or selling. Then there's a little less I can do after you've already sold it, but we're still in the year. If you call me in January 2021, there's not much I can do for 2020. So I like to have more of a proactive relationship with clients. And really, I think every investor really needs to, especially as things get more complicated, because as your business develops, you're also going to run into a situation once you start dealing with lenders. And yes, paying minimal tax is great, but having lower taxable income is tougher to get lending on until you have a great substantial rental portfolio. You can borrow on the asset. But if you're an active flipper and not making a decent living, it's tough to get funding when you flipped 10 houses last year and your records are showing that you only made $15,000. And when you have hard assets such as real estate, if you owned 20 properties, made $15,000, $20,000, you could probably still get a mortgage. And there's other opportunities as you grow. But that buy and hold investor, you have 1031s available, depreciation. Costs are going to be deductible when placed in service. And again, think of yourself just as that traditional landlord. Then I also get into the investor / portfolio. Think of Google stock. You're going buying a stock, waiting for it to appreciate. No different than buying a vacant parcel of land on a busy intersection. You're waiting for the day that I own it for 5 years and Starbucks is going to knock on my door and buy that property from me. And I paid $500,000 and they're going to offer me 1.2 million or whatever it may be. I think those numbers are a little bigger, but at least so everyone can conceptualize this. I spoke with someone else today that was buying a vacant piece of property in Detroit. It was at a nominal cost, but really their intent is to buy that property, own it for maybe 4 to 5 years, depending on the neighborhood, potentially develop it into a home, a strip mall, or just sell it at a profit. If I own it through my active flipping company, that's really an inventoried land, and I'd really hate to buy that property for $50,000, sell it for 150, make 100,000 on my investment. Yes, I get to deduct my insurance and my property taxes, but I'm going to pay self-employment tax and ordinary income tax. That same activity, this is where using different entities to hold your real estate can make a difference, because the one thing to keep in mind, everything in the IRS says the taxpayer. The taxpayer is me, Frank, but it could be myself, my investment LLC, my flip LLC, my buy and hold real LLC. Um, I'm not one for overcomplicating things with too many LLCs, but this example of just buying some dirt that you're going to speculate is a perfect example. I would want to probably separate this activity in its own LLC and really hold it for long-term investment. My carrying costs, such as property taxes and insurance, are going to be something that's an investment expense, not deductible because of the current limitations on Schedule A, no different than portfolio deductions on your margin account that you may have with a broker. 1031 is not going to be available in that transaction, but you're going to have the biggest thing is you're going to be subject to capital gains, which is 0 to 20% based on current tax rates right now. If you lose on that deal, your losses are limited to 3,000. So if I lose 50,000 on this property, or let's say 30,000, it's going to take me 10 years to extinguish those losses because they're investment. This same activity, I could write that 30,000 off this year. So a lot of times my best answer to a client's question is it depends, because I always ask, what's your intent? What are you going to do? Are you a home builder that's buying some dirt to build some houses on and sell? It might be some planning where we can really capture the capital gains and the ordinary income. If you're buying the dirt today, you don't expect much appreciation, and then you're going to sell the houses. You're probably going to fall into ordinary income. If you're buying dirt and you're going to build a rental property, might be a large situation such as large commercial, a strip mall. It might be a situation that no might be a situation that you're going to buy some dirt and I'm going to build a storage facility on there in maybe 2 years from now. As my rental activity, that dirt that I buy for 50,000, but when I put my actually begin construction is worth 100,000, my basis will be 50,000. But if investment LLC sells to rental storage rental LLC for 100,000, I might, between the two LLCs, recognize $50,000 capital gain, and based on current rates, might pay a minimal tax gain. But then now my storage facility is going to have an increase in basis, and it really needs to be a brother sister type transaction, that entity A and entity B are not a entity A owns entity B. It needs to be two separate companies. The new operating company could be one that I have partners in, but me personally, Frank, would have to recognize gain at the time that I do that. So depending on the numbers, it's not for everybody, but it's definitely an opportunity. And then in the meantime, that piece of dirt that you're carrying, maybe you put a cell tower, let somebody put a cell tower and a billboard on it to pay some of your property taxes. That's really going to be more de minimis rent. So I'm kind of tried to lay down some definitions, I guess, to keep on the focus tonight, because which bucket your activity is going to fall into is really the biggest thing for any investor, whether you're a wholesaler looking to get started, you're looking to flip some properties. You might be someone flipping properties to fund your longer term rental business. And then those of you really like to bring up the fact about passive, because those of you that are active may have a different situation than when you're reaching out to that doctor friend to invest and telling them about the losses that they're going to benefit from. But the doctor makes $400,000 a year and you're going to syndicate a deal and he's going to get 50,000 or 100,000 in losses. Generally, he's going to be limited, so they're not valuable to him today. They might be valuable to him as a longer term investment play, but really understanding as you start to work with partners and other investors what the deal entails. So, and also how it's going to impact your return. And really, if we can, for those of you with passive income or passive losses, utilize those to reduce some of your ordinary income, be it your active flip and current buy and sells that you're doing, or other W-2 that you have if you're a current W-2 investor. Any questions or anything on that?
You have tons.
Okay. One about the slides, I will be sending, I can send those out. Again, they're just for informational. Don't base any of your decisions or investment decisions on them. And I'm not saying on the nature of something being a good or bad investment. Then record keep on the house is dirt. Okay, so here's a question. Someone bought a house, bought some houses dirt cheap and holding and really sitting on them, waiting for future rehab or income coming in. So right there is a perfect situation. If they're just sitting there, boarded up, vacant, you're paying the property taxes, cutting the grass because you have to cut the grass, but you're doing nothing with them. That would be a perfect situation that I would say you might put that in new investment LLC and really have that maintain that as an investment, because maybe the area turns around and your intent is to sell those. If you're going to tell me that you're holding those because you're going to flip them and put 50,000 into them and that neighborhood's going to turn around and those houses are going to sell for 400,000, those separate entities might help, because if you're the guy that's also doing 10 flips a year, all in your personal name, as I quoted earlier, taxpayer is really defined loosely, or but it's the person. So if Frank is flipping 10 houses this year, but also owns some dumpy houses that he bought dirt cheap, who's to say these weren't just flips in ordinary income? That's why I personally would set these in separate LLCs. So my active LLC at a future date might buy these at a capital gains transaction from my investment LLC, but I still have flexibility. Yes, it's a little bit more complicated on books and records, and I tend not to advise clients to complicate things too much from that standpoint, but I'd rather at least discuss 5 options that you'd have, and you can decide, no, you only want 3 of them. Otherwise, I'd rather advise a client to have 5 options and maybe never need them, but when you need them, it's tough to unwind what happened in time. So might be something to look at, really depending on the number. If we're talking a $5,000 house that you think might go up to 10,000, it's a great return on investment depending on the time, but it may not be as much exposure for the additional record keeping. If we're talking a $500,000 property on $1 million sale, it's definitely worth the additional record keeping if we can minimize that tax. So let me look. So one question is, the amount of rental passive income make a person lendable, generally speaking? So really, a person being lendable is gonna, if someone's got a W-2 and has some passive rentals, for one, they're gonna look at the properties that, if you're getting a mortgage, then your W-2. If you're just a full-time investor and trying to get rentals, that's a different area, and I would advise really an investor friendly mortgage company. I'm not a mortgage broker, so can't really speak. And I've seen deals go through that I thought the person was never lendable. And I've seen ones that I thought the person could get money all day long and had a hard time getting it because of one reason or another. So again, really establishing those relationships with that lender on the front end. And also, I always stress having that good, solid tax return. A lot of times I get questions, what's the best refund you can get me? I don't know. I'm going to get you the right refund. I see tax returns quite often that I never could get the refund that they got because it's just flat out wrong. And I've not been able to do those. Other ones, if everything looks right, I usually, unless I see something wrong, there's circumstances that I might look at your return from last year, but you've been an investor for 10 years. It's hard for me to really say it was right or wrong at the time because of the facts and circumstances 10 years ago. You made certain decisions when you had a very strong or a very weak W-2, as you can see, impact different things. Or it may be just you didn't have the right advisor, but I, we could speak further on that, but really, I think having a strong, solid tax return that makes sense makes you lendable. If you're dealing with a private lender, for instance, if somebody can't put together a deal and tell me what their profit's going to be and show me some history on deals they've done, I may not be interested. Again, real estate's deal by deal, and who's going to have control? Do you want my money and you're going to have control, or are we going to be partners on it? Anything can be worked out in real estate. So in that case, you might be lendable if you give up control or a profit split. Anything can be done. And I think those of you on this call have seen some creative things that you probably never saw before you got into real estate. So
I would like to add something.
yes.
I have a bookkeeping client that he is not currently a real estate investor, but he wants to be. And I've been helping him for a couple of years with his books, and he has never filed taxes. And I would advise anybody doing anything really, and this man is a grown man. He has never filed taxes. He is not living in the gutter, let's say, and he wants to borrow money from the bank, from the neighbor, from whoever. If there's anybody on here, and I'm thinking there's probably not anybody on this call that's not filing taxes, but just do it even if you're not making any money. Some people think that if they don't have to pay taxes because they didn't earn enough to pay taxes, that they don't have to file. You have to file, no matter if you made money or not. Right, Frank?
Yes.
I'm just, this could be your brother-in-law that isn't paying his taxes or doing his taxes, but just anybody listening.
Or I think sometimes in certain trades or whatever, you've got the guy that works for cash and will only pour your cement with cash and he'll be there tomorrow. But yes, he can make money, but nobody's
That's
ever
good
going to
until you want to buy something real.
Yes.
So, okay, that's enough.
So one question I see comes in as far as rentals, not having any losses, then having offsetting income. So if the rentals don't have any losses, you'll just have additional income, which is going to be taxed at, as I said, on the buy and hold at the ordinary rates, not subject to self-employment. But then in the same situation, dealers versus capital gains. And I think the question was kind of alluding to what really comes into play. Think of the home, the Pulte homes that come in. they buy a piece of land, build a bunch of houses. They're really treated what's called a dealer, and they're falling into what's called ordinary income. They're probably not doing a Schedule C. They're a public company. It's on page 1 of their tax return, but it's going to be taxed at ordinary rates. That question then, the standard capital gains, the IRS is going to look at number of transactions. Are you that investor? And that's the perfect scenario that they're going to have the investor structure for that speculative land. Most home builders and developers that I deal with usually have an investment entity, a development entity that'll go in if they're a developer that develops the roads and neighborhoods and the sewers and does that. And then they'll effectively have the company that you and I are going to buy the homes from. But what they're doing is they come in, they'll buy through investment company, they'll buy for land on the outskirts that they're going to build on in 5 or 10 years. They're buying up that raw land for that investment. As it appreciates and they're getting ready to break dirt on it, there may be a transaction that they recognize that, let's say, home builder investment company sells to home builder that's going to be building. There's a transaction at this time that could be done to recognize capital gains, effectively locking in that lower tax rate. Let's say the property was bought for 100,000, appreciated to 200 and sold to this company. That's where then now the development that's building the homes has basis of 200 in that land, and really increased it by selling it from that brother sister scenario. This company is going to sell to this company, and they might be owned by a holding company. Then you run and that's where separate entities, this LLC's operating agreement would probably read something that investment or company is set up for the purpose of long-term investment in real estate, make no statement of developing or selling homes. This company here's operating agreement would probably limit them from buying any investment properties. It's really facts and circumstances. I think the $3,000 lot that you buy in Detroit that you hope turns into a retail area that you sell for 30 grand, your risk and exposure is going to be different than that $1 million parcel of land that you're hoping you can sell for $5 million to be an office building somewhere. So it's always facts and circumstances. I wouldn't say beat it to death if we're talking $3,000 pieces of property, but as they grow, and at least my point here tonight is really to be able to give everybody the tools to know when to ask the right questions, and hope that helps. And then I think I covered everything. Then keep it.
I put one more in there. Tom Hutt had a good question.
That was kind of what I was covering as far as the investor versus dealer situation. So, okay. So another thing I always get, so the one question is asking about the 100,000. So that's going to be based on taxable income. So depending on adjustments and how that works. So you might have someone that makes 100,000 on a W-2, but there's some adjustments that are going to, or let's say 103,000. Are they going to be subject to a phase out? Generally, someone that makes 150 probably doesn't have enough phase outs to get them down below the 100, unless there's some other weird things, some substantial business losses, you've got the W-2 guy and he lost a bunch on a flip. You could probably get under that 100. Then I see a question on real estate professionals. I'll kind of cover that a little bit more. Real estate professionals, a beautiful thing, and sometimes something to be aware of. So, um, um, that'll be further on. Then there's a question about 1099 wholesalers. So with the with the title company, you've never actually generally taken possession or paid that wholesaler. So if my client bought a deal and goes to the closing table with the purchase price, and then the wholesaler gets the fee, I would argue they never paid it. Somehow it was a transaction that the title company. If the wholesaler received it, I would say recognize it and pick that income up. If it's the situation that I get the proceeds and then I'm going to pay the wholesaler, absolutely you have to 1099 them. But if you hadn't paid them and you came to the closing table with net, um, I have clients that kind of do a little bit of both. Generally err on the side of not giving it because they don't necessarily always have that W-9 information, and I don't know that that wholesaler necessarily has that obligation to give it to you either. So, but let's see. One question I get, which expenses are deductible? All expenses related to your business generally. And as I talked about the different buckets earlier, which ones, because they all fall on different lines on your return. So biggest mistakes real estate investors make: deducting items in the wrong place, then really what business they are in, W-2, investor or landlord, limitations on passive losses, rules versus real estate professional status, then really lack of proactive planning. Now on your rental properties, really starting to advertise that property for rent the day you close from a service date. If we're talking a full rehab, um, um, then on a full rehab, you're going to have some time. But if we're talking that I'm going to have about 30 days, I would say start advertising that property right away. And that's really going to be more of an in-service date. Another thing I see quite often is needing an LLC to get started. Those of you new investors, get out there and get started. And you can, as you get a deal, maybe right before you get to the closing table, we can get there. But I see more multiple LLCs or series LLCs, or some guru sold a course on CS and all this stuff, and you end up with all this tax compliance before you've ever done a deal. So I like to find that proper balance. So but again, not having a structure that's going to give you the guidelines to fit everything into what we talked about previously is going to be key. And then also, if you, those of you with partners, really getting things spelled out for the legal disputes. Get it all in writing at the beginning, anticipate the worst, and you generally are going to have a great relationship with a partner. So some more on the mistake side, again on structure or accounting for depreciation, more on the escrow payments if your lender's paying that, and then really not using all the tools such as 529 plans for your kids if your business is large enough to start to take advantage of those and make those worthwhile. And then also some of the other opportunities such as 1031s and that. And then one question that came in, structuring LLC or corporation if you're a new investor. It really depends what you're doing from that investor. Are you looking to wholesale or flip? I would say more maybe on a corporate side sometimes. with an asterisk there. If I'm a buy and hold investor, I would say absolutely every time, all day, put it in an LLC because of the cash out refinance option. A lot of people I see do it in error through an S corporation, and that's actually causes a taxable event with a distribution in excess of basis. Could actually probably spend another hour talking about that, and maybe if people are interested, I could do a video on that or have something on that. But really, from the buy and holds, from a tax standpoint, you're better off individually or an LLC than you are to ever put it in a C corporation unless you're a public REIT or an S corporation. So here's some bookkeeping best practices. I think I'm probably just include this in the slides I can send to everybody. It's really the biggest thing is separate bank accounts and credit cards that I really like to, more times than not, I see personal accounts used, multiple credit cards. Treat your business like a business, I like to say. And I could maybe spend more time on bookkeeping for those that are needed. I think someone mentioned bookkeeping and QuickBooks, and maybe set up another time for that. We could probably spend another hour on that someday. So I'm kind of looking at the questions. It looks like some of the future changes, I think, just as we're getting pressed for time, don't mean to be skipping and I think that's some of the interest. Let me see here.
You see the question from Vicky at about 7:40, the non-recourse loan.
Okay, sorry about that.
I just thought, they're all important questions. So that was asked twice.
Okay, so here's a great question. Purchasing a property in a self-directed IRA with a non-recourse loan, then keep it as a rental for several years, and during that time you pay off the non-recourse loan from the rental income. The next year after the non-recourse loan is paid off, you sell the property at a profit. Do you still owe the UBIT, which is the unrelated business income tax on the profit? Honestly, I don't have that answer off the top of my head because with more on the buy and hold, the clients I deal with that have self-directeds are more on the lending side or buying properties not subject to debt because of the UBIT issue to begin with. It's something I could definitely look closer at, but I don't have the actual answer. I would believe it would not be, but I can't really conclude on that right now, just because I don't deal with that and tend to, on the buy and holds and dealing with the recourse debt, it's a situation I wouldn't recommend for every investor, and it can easily get screwed up. So don't have the answer on that, Vicky, but I think as you're aware of, there's very strict rules with that if you don't follow those, it could trigger your whole situation being taxable. So I actually don't have any that have that situation, so I can't.
Why I put it out there to ask it twice, just because I haven't seen. It's something I haven't heard discussed about people keeping money out of their self-directed IRA long enough for it to be a long-term, long enough to pay it off with rental money. So I didn't know you could even keep money out that long. So
well, with the self-directeds also on the rental properties, at that future appreciation, if it's a Roth vehicle, it's going to be something that's not taxable. And based on the current tax laws right now, with buy and hold and refinancing and 1031 exchanges, you can effectively defer taxes indefinitely till death. With a an IRA, that appreciation on that property, when you sell it, you effectively can't refinance that and take those proceeds tax-free. So that's why I sometimes don't see investors that they're more lending money in those situations and not necessarily on the buy and hold as frequent. But again, do everything you can do to get started and use the tools you have. Um, but so going to kind of move on to 1031 exchanges. And right now, 1031 exchanges are a great tool. Those of you that have properties more on the single family, a lot of times there's some cons with that. You have 45 days to identify your new property and 180 days to buy your replacement property. It's a great vehicle to defer taxes indefinitely, but you really have ever-changing tax rates, and taxes are deferred and not tax-free. Um, Again, there's been some speculation that 1031s could be eliminated, and I'm not sure if everybody is aware of that. 1031s were eliminated in their entirety with the 2017 tax cuts. Um, so think of trading in a car. Every time you traded in a vehicle and bought a new vehicle, that was a 1031 exchange. So the construction worker who traded in that work truck um, ultimately did a 1031. They eliminated it across the board because it created a lot of situations. People got stuck into it in a car. It wasn't a great deal. You trade in a business Mercedes for a business Porsche, and you're limited on that. It didn't result in a good situation. They did at the last minute put real estate back into it, and there's been speculation that it could be eliminated or limited with the new administration. So also for the investor that's going to that's not necessarily as business savvy, I would say it could result in a large gain at a time of sale with little proceeds received on leveraged properties that have had previous 1031. So once you start doing that, it's something to be aware of the situation, I always advise. But again, it's just another planning tool to be able to look at. If you're selling a $30,000 property, it may not be as advantageous as opposed to a $1 million property. But you can also take a pool of 15 rental properties. If you structure the deal correctly, do a 1031 into 2 multifamilies down into Florida where you want to retire. So I've had clients that have sold multifamily deals into commercial properties, into properties in other states. So if it's structured correctly, it's a great way to really diversify your portfolio. So and we'll just see what future legislation brings with the new administration. So then cost segregation is another tool that comes up. Um, Wrong slide, sorry. Cost segregation's another strategy I get quite often. And it really comes down to those of you that have your properties that you're rehabbing. Think of you're going in, doing improvements to the property. And in this case, I just found a quick example. You have a 5 million, but let's say it's a $50,000 property. That same segregation you would allocate to different buckets, such as 5-year property, 7-year, and 15-year. That and actually this would be 27.5-year on single family. But what that's going to do is really accelerate your depreciation. That passive W-2 investor, it doesn't matter what depreciation he gets if he's limited. It'll just increase his passive losses. So cost segregation becomes a big question, but I always say use it wisely. You don't need to get overwhelmed on the smaller deals because you still may be a W-2 investor, or your outside investors may be on large office buildings. Then also on a cost segregation, are you a real estate professional? If you're a real estate professional, absolutely all day long, you should be doing a cost segregation. You'll get substantial benefits. That doctor that invests in a deal that gets a cost segregation, he'll get a great passive loss. It might offset his passive income that's coming through on deals he invested 10 years ago. So it's really a situation. I have a client that does multifamily, low-income housing, and they'll buy anywhere from $5 to $10 million properties and put a few $1 million in renovations and their large tax credit deals. Their investor is generally more on the institutional side that is investing in the deal for the tax credits and the depreciation. In their case, it's passive, but it offsets their other passive income. And they'll effectively, their renovations on the multifamily with the cost segregation take multi-million-dollar first-year deductions based on that. So it has its place. But again, a cost segregation is, and I don't think I have it in here, it's a formal report generally written by somebody with an accounting background, but also an engineering background. It's going to be, they're doing a site study, an engineering study, and looking at everything within your plan. Think of an office building. As an accountant, I can tell you the numbers, but you need an engineering background. And if you don't have the proper documentation, I can tell you it's not going to hold up under IRS audit. And there's companies you can find online for $200 that'll do them, and they're probably not worth the paper they're written on. So it's something to navigate, but at least be aware a deal may present itself. It's a great opportunity. The larger deals, more on self-storage, a lot of that material is personal property as opposed to structural buildings. So they're great opportunities. Then I have a couple examples here. Looks like a couple people. Here are a couple examples. Wanted to get into somebody purchased a home in 2018, primary rehabbed it out, turned it into a rental in 2020. What happens with the rehab expenses and cost basis and the amount used for depreciation? So in 2018, they purchased it. Then you would add the rehab cost. Then in 2020, they depreciate, they place it in service as a rental. I would take the purchase price plus the rehab as the cost basis that I place in service in 2020. Then further on, they have another property in 2020. They currently rehabbing, and it won't be rented until 2021. This is the example being of that flipper that I said, and it's not a flipper, but again, you would take that purchase price, add your renovation cost to your what's called your basis, so you're not losing it, but then your depreciable basis will become whatever you've done, and your in-service date will be 2021. So if you put that tenant in there January 15th, that's going to be your in-service date with all the costs you incurred in 2020, plus some that you might have incurred in 2021. Real estate professional was a question that came up, and the key with that is real estate professionals need 750 hours related to their trade or business. So real estate professionals, I get quite often, and a real estate professional is not limited on their losses for that $25,000 example we said. So that investor that is continually adding to his portfolio gets into some deals and does a cost segregation and generates a loss on their tax return. If they're a real estate professional, will be able to utilize those losses. To qualify as a real estate professional, you need 750 hours per activity unless you make a grouping election. And then you must materially participate in your business. So and it has to be your greatest activity. So if I'm a W-2 and I work generally 2,080 hours, I have to have 2,100 hours or more than 2,080 in my part-time business to qualify. If I have no job and I'm in the real estate business, my real estate activities need to be 750 hours, but without the grouping election, I have to have 750 per property. So I usually make the group, always make the grouping election for clients. But then what that does is it allows you to take your hours you spent on your flipping business, your management of your properties, your rental activities, group them together. If you're at 750 hours, you would qualify as a real estate professional. Sometimes it gets tricky when you're navigating between coming out of a W-2 with some passive losses and you become technically a real estate professional, and we don't want to lock up those losses and how to utilize those. So again, proper planning. Here's an example to a court case decided both cases. First taxpayer owned 5 rentals totaling 8 units. Second taxpayer owned only 2 rental properties. And then the question is which one successfully defended the real estate professional status. It was actually the second taxpayer that only owned 2 rental properties, because they that second taxpayer managed those properties and was much more actively involved than this first taxpayer that owned 5 rental properties. And I didn't put it here, but they also had an outside management company, and they were effectively sitting on a beach while somebody else managed them. He owned more. This guy was involved more, and that's what's the key. So I've seen returns that people just check the box and think they qualify, and I've actually turned away a client or two that I wouldn't take a position because I knew they had a W-2 or some other circumstance that they didn't qualify. But I think quite a few of you do qualify, knowing people on the call tonight, and some really the key to get you there as you grow your business. Now I guess on to the fun stuff and the crystal ball. So right now there's a lot of speculation, and I'm just gonna put out what I've seen in some proposals. Right now, a lot of the more further analysis, as I said, 1031 exchanges have been speculated to be eliminated. And then there's also been speculation of limiting them based on your income limitation. I personally think it will be a nightmare to have a rule that is only in effect with people that make over $400,000, because proper planning, we can get you under that $400,000 to qualify for a 1031 in certain situations. So I don't really know what's going to happen with that. Again, 754, which is a step up in basis, it's really used on that property that has appreciated or cash out refinance situations. It's an estate benefit. So let's take, for instance, dad dies, has $1 million in property that he owns, and he bought it for $100,000. I inherit the $1 million. Dad's not a rich guy, has $1 million. I inherit it. He doesn't pay estate tax, and I sell it tomorrow. Is my gain going to be $900,000? Under current law, I get a step up to $1 million, and I would sell dad's property at $1 million, pay off any related debts, and keep the difference. Without the step up, if dad gives me a property that has a $900,000 mortgage that he paid $100,000 because he borrowed against it, bought a boat and and drove his Corvette, and he bought the property for 100, owes 900, gives me the property for $1 million. I sell it for $1 million. I pay the bank the 900. I keep 100, but I have a $900,000 gain that I have to show. I would rather just refuse to accept that property. So I don't know that they can really do away with this, because you also have to think, Dad gives me that appreciated Ford stock that he bought in the 60s. I may not be able to sell it without paying quite a bit in tax. So 1031 and 754 really work hand in hand. And 754 is an option that's not available. Those are part of the partnership regulations. And that's why I say buy and hold real estate should be in a partnership and not in a corporation, because 754 and revaluing assets doesn't apply if it's owned by an S corporation. There's different rules that falls under, and they're nowhere near as advantageous. One of the other questions that I had was on opportunity zones, how I see those happening. Realistically, I believe those are probably going to go away, opportunity zones. And there's been differences of opinion whether it stimulated the growth in the areas that were needed, and or was it a deferral. There was some great opportunities that I could sell a property, skip the 1031, and invest the gain into opportunity zones. And let's really take into account, really the opportunity zones were created by, I can't think of the guy that was, Sean Parker had a lot to do with it, from Facebook and Napster. But you have to think, Facebook stock, he owned at X, it's appreciated substantially. He could sell that, not pay tax on that gain, and go buy real estate in opportunity zones. And if he held it for 5 and 10 years, there was huge tax deferrals. I've never seen anything like that. And it was really actually pushed. I think the originator of it was Sean Parker from Facebook and Napster that had pushed for that. But I believe those are just going to disappear. Again, can't speak. Ordinary income tax rates, I anticipate they'll probably go up. I know there's been talk that there will be income limits. I'm not entirely sure how that'll be impacted. And some of the 2017 legislation I expect to be rolled back. We could see a return of exemptions for those of you that have children, but we could also see a reduction in the standard deduction. So a lot of it's still up in the air and speculative on the, and good and bad. And yes, I saw Napster. And yes, I just did say Napster. So for those of you that don't know a little bit of geek history, the guy that was involved in Napster was involved in Facebook, and that's a story for a whole nother thing. But capital gains rates right now are the lowest I have ever seen my entire career. I would anticipate those are going to go up, depending on where they go up and how those capital gains rates are used in conjunction with any possible 1031s, and understanding 754 step-ups. I can see 1031 market growing if the capital gains rates go up drastically. But if they do away with the 1031, capital gains rates will be a different situation. If they go up too much, I could see it having a negative impact on the real estate market. And then the big question is retroactivity. Back in '93, I believe Clinton passed in August a tax bill that was actually retroactive to the beginning of that year. So it could happen. Arguably, you could sell a house today and not know until next December what the tax rate's going to be. So again, 2021 is going to be real speculative and a lot of planning. Those of you that signed up tonight, I will try to, throughout the year, keep you abreast of any changes or anything I see coming. And right now, this is all just speculation again. And as it says here, everything in this presentation is not meant to it's based on the date of this presentation. It could change tomorrow or 6 months from now. So again, that it's all just speculative at this point. And I left up here ways to reach me. I think those of you that found me, appreciate everyone on here. And I had planned to end this tonight about 8:30. It's 8:15. I can leave it open for a little bit and just plan to take questions and open it up from there and kind of keep it as a dialogue if that works for everybody. Let me see if I have any other.
I sent you tons.
Okay. I'm looking back at the.
They're all good. All important.
Okay, one question, best way to get business credit cards. When you go to a bank, a lot of times they'll give you a credit card. You might start, let's say the bank only gives you a $1,500 credit card. Really to establish that relationship, use it and pay it down. Another thing I tell people, I do have clients that have couple credit cards. They only use one credit card. Take that other credit card you don't use and only run your business transactions from there. If you have two personal credit cards and one is business and one is personal, I would have no problem discussing with the IRS that one is all business transactions. But when they see your movie theater ticket purchases on there and everything else, they'll say it's all what's called commingling. So arguably, preferably a business credit card is better. But if someone can't, or maybe some of you flippers out there that are moving much more money on a credit card, you might have a credit card with a $10,000 or $15,000 limit. You might have to pay it off more frequently, but I would use that card solely for that business activity, and effectively the business pays that, and I would record those transactions as a business expense. It's much tougher when a client has a starting balance of $3,000 they owe and they charge a bunch of business and personal and want me to figure it out. It's what's called an accounting nightmare. So then next question, property assigned to sell, then they send the private listing to a new wholesaler that's never done any real estate deals. How does the new individual make money if they bring a serious buyer for purchase and that there are two other individuals that are working on the deal? If you're bringing a buyer, first off, if you're a real estate agent, it should be a real estate deal. If you're a wholesaler, I wouldn't be working on anybody's deals until you have an agreement with them in writing. I'm of the position, trust nobody, and would not take the position to work on finding you a buyer if you're not going to plan on sharing something. I could find you the buyer and you two connect and never pay. So some of you new or seasoned wholesalers, I'm sure will tell you, the newer wholesalers, that that's happened to, unless they're finding you a buyer. So it could happen. Then
Right before that, Frank, there was a question about a subject to tax implications for taking over an existing mortgage on an investment property subject to.
okay, so if somebody's taking it over, so I'm taking over an existing mortgage on a subject to, I'm generally not going to have tax implications because I'm acquiring that property. The person that I'm taking that from, are they an investor? They may have implications on a recognition of sale, and then they that investor that I'm taking the property from might have implications, but if I'm the one getting the property, I don't know that I care, and I would say have them talk to their advisor. If I have the property I've acquired on subject to and I sell it, depending on the terms and the length of the deal, it would your tax implications would be more on the capital gains / investment side. Um, Again, each deal could be structured differently. I've seen them more on a wholesale type present deal or on a longer term investment. So it would really be deal by deal, but definitely if it's your taxes, when you're acquiring it, generally you would have nothing that has tax implications. Then somebody brought up as far as marketing, as far as the data and service. And I would say that from a point of rehab, if it's a full gut down to the studs, I wouldn't be hanging for rent signs in it. I mean, if I'm going in and I need to paint and lay down some carpet, and especially if it's a transaction that I bought November 15th and I really want to get the tenant in there and take depreciation for last year, the sooner you can market it and get it on the market would be better. Again, if it's not even available for rent and livable, we're probably not going to place it in service in 2020. But then again, if you incurred costs and marketed that property and found a tenant who did not move in until January 1st, we would be discussing whether we're going to take a month of depreciation on that transaction, and having the facts and circumstances of the in-service date, meaning it was available for rent, marketed for rent, advertised for rent, are going to be the things that we would want to take into account. Those of you down to the studs, don't place the for rent signs yet, you know. Then I do plan to email the client slides. Then, here's a question. So you buy a house for $20,000, you depreciate it by 20,000. So it's what's called effectively your basis is down to zero. And then you sell it for 30,000 40 years later. Are you going to pay gains on just the 10,000 or everything? So that property that I bought for 20, I depreciate down to zero. I'm going to then sell for 30,000. In my mind, I only made 10,000, but your taxable gain will be 30,000, subject to what's called recapture. 20,000. 40 years from now, I would say the rates are going to be totally different. But in that same situation, so your gain will be 30,000. But here's a perfect example of the 754. If dad bought it for 20, depreciated it to zero, and then dies and gives it to me at 30,000, and I sell it, I'm going to have a full 30 gain on that 30,000 unless I get that 754 step up in basis to fair market value on the date of his death. So I can't see that going away in its entirety. It's been said it will go away, but I have to believe if I inherit dad's 30,000, I don't think the government wants me to pay tax on everything. But then again, the government wants tax. So. But then
that was Carson. He'll be around for all that time, so he'll be the one to sell it in 40 years. He just wants to know is he going to pay taxes on the whole thing?
Yep.
Yeah, he appreciated the whole thing.
So another question: loans available for this bailout for landlords, and then really. As far as from a relief standpoint, there's been the different relief, there's been different funding grants out there. A lot have run out. I have clients in different situations. Some have been having to take discounts effectively and on their rent and sign off on that. So Does that mean when the lease comes up for renewal, I'm just raising your rent the 10% I lost during COVID? A lot of things are going to happen. Right now, I know that they're saying they're going to extend the rent moratorium. And again, it's all speculation, but all of you that are landlords, you have property taxes and utilities and insurance. There's nothing aware of that. I mean, any grants or relief or bailout as of today that I'm aware of. Those of you that are on this, right now, I would say reach out to your bank for rounds of PPP2 funding that's opened up, and anything, open up that communication, get that. Those of you that had any EIDL loans out there that applied, one thing I would say, read the terms of your loan. I have people that took those and didn't read the terms, and depending on the dollar amount, $20,000 loans had different terms than the $150,000 loans. And arguably, there's people that are using the funds not necessarily what's prescribed in the loan document. I don't know that they'll have an issue, but with every program, somebody's going to have an example made of them. So I don't want it to be anybody on this call. So double check your loan documents. If you just did the DocuSign and never read them, there's some language in there that sometimes is a little bit too cumbersome. Other times it's not. And I have other clients that know the risk and are running the risk. So that's fine. Then so one question. Oh, and then another question: QuickBooks Desktop versus QuickBooks Online. I personally like QuickBooks Online because QuickBooks Online, a client can share access with me. QuickBooks Online has a cost per entity, where QuickBooks Desktop, you can buy it one time and install it. I have a client that actually just set up 5 companies. He set up 5 versions of QuickBooks, and his monthly QuickBooks is probably going to be about $200. And he's running his business like a business and actually having a great year, and already on his way to have a great 2021 year. So again, it's a cost. And I have clients that use QuickBooks and their records are a mess. And I have ones that use spreadsheets and they can track everything. Really what's going to work for you and what's going to work to be able to give it to your advisor. But the biggest thing is, I think one of the mistakes a lot of investors make is not really knowing their properties. It's times like COVID that a lot of them, I think, felt the pain of their business. But those of you on a flip, are you able to see what your profit is on the flip, where you are over, under on budget, doing a budget to actual analysis? You'll be able to start to do those items, a different analysis with a computerized accounting system. I think someone earlier mentioned working with bookkeepers, not getting the information they're looking for. And it's really key as you're running your business to get the different KPIs, key performance indicators that you need to run your business. I think those wholesalers on this call will know how many calls they make to get an appointment and how many appointments they need to get a deal under contract. They could tell me that all day long, but they can't tell me how much money they made last month and how many deals. So, and that same philosophy goes to whether you're flipping houses, anything you're doing. So the better your records, the better handle you can get. You could make money, but you could also grow yourself out of business with cash flow. You can effectively be losing money, but have a lot of activity and effectively robbing Peter to pay Paul. A lot of home builders I've seen do that. And effectively, when sales dry up, they go out of business and bankrupt. So learning your financials and if anybody's interested, maybe we could walk through something, what those mean. I know balance sheet and income statement and rent rolls and profit and loss by property make a difference. Those of you landlords, how many of you own properties that you have some real dead property, dog properties, and some great ones that are cash flowing? Does it make sense for you to sell your non-performing properties? Could you sell them in this hot retail market right now? Something to consider. If you unloaded some, you could lock in some great gains at low capital gains rates and effectively put cash in your pocket and decrease the future funding that they've been absorbing from you. So if you know
Selling for
that,
top dollar right now.
oh yeah, and if you know those different things and those numbers, you would know which property to sell. Then there's a question about LLCs saving money on taxes. Uh, an LLC in and of itself versus an individual isn't going to save you money on taxes, as opposed to having an LLC and good behavior, such as an accounting system and disciplines of where your money's going, is going to help you understand your business and running your business like a business. But effectively, as I stated, if you're a Schedule C proprietor, what used to be called a sole proprietor, flipping houses, or you're a Schedule E guy, anything related to your business with a business purpose is going to be deductible. I will say that in LLC, I spoke with somebody last year that went to a bunch of courses, did a bunch of advertising, incurred about $25,000 in expenses, and never did a deal, or at least I think closed a deal. So he effectively had a bunch of income, or I mean expenses, was running as a business, but he had a W-2 job. IRS actually allowed his Schedule C loss. Then the state of Michigan disallowed it because they said it effectively wiped out half your income, and it was what's called a hobby. And all he had really to show it was a business was business cards in a PO box, and disallowed his Michigan refund. Since then, he's moved to Florida and stopped in real estate. So arguably, he never really got started. But had he had an LLC or S Corp, it probably never would have been an issue. That's just the odds. It wouldn't have saved him and he probably could have. I don't know if he could have fought it. It wasn't worth hiring me to fight it. He lost like an $800 refund, and I said it'll cost you more. And during COVID, I can't even get him on the phone, so to spend the time. But then but really having a business structure, I always say treat your business like a business. I have investors that personally own a bunch of properties or in disregarded entities and run it as a business. Other ones that have 5 LLCs and S Corps, and everything's a mess. So treat your business like a business. Another question. So the tax rate on the recapture, so the recapture effectively is going to be a blend between capital gains and ordinary. On that example of 30,000 earlier, the 20,000 is going to be recapture at a blended rate, because you have to think it was depreciation that caused it to go to zero. I depreciated $20,000, which offset ordinary income. And then that additional 10 is going to be capital gains, which right now is a lower rate. Again, they both could be the same in the future. I don't know, a $30,000 transaction in real estate might effectively not be taxable if that's the only one you do that year. A $30 million transaction is going to be subject to huge taxes. So again, real estate is just bigger sticks and bricks, bigger pieces and bigger numbers, but just each deal, and really the concepts. Sometimes the smaller deals, I say, don't get lost in the details, but it's all worth looking at. But if you sell 10 $30,000 houses, that's 300,000. That's nothing to ignore. So another question: when do you have to do 1099s to contractors that are S Corps? And what about people that provide materials but not labor? So right now is 1099. Those of you that are on the call, any of you that prepare or pay any of your contractors greater than $600, and that's not 600 per house, it's 600 per entity. So I own one LLC that owns 12 houses, and I have a contractor I pay $100 per house. I paid him $1,200. I have a 1099 obligation. I always suggest have them fill out a W-9, and then from the W-9, you'll be able to determine if they're an S Corp, C Corp, LLC. If they're an S Corp or a C Corp, you don't have to give them a 1099. Any other entity, give them a 1099. If you give someone a 1099, you didn't have to. There's no harm done, but arguably, if you don't give somebody a 1099 that should receive one, then there could be a problem. And then if they're an S Corp, you don't have to give them a 1099, and you're paying for services. Buying materials such as like Home Depot or yeah, and I'm going to pull Vale out here. I see his picture. I buy it from Vale's Building Materials. I get all my wood from. That's I don't have to give him a 1099. But Vale's Construction Services, I give him $10,000 to do a kitchen for me. Of that, he pays his guys. He has materials. I give him the 1099 for $10,000. Of that, he might give 1099s to his guys for $2,000. The rest was materials and his profit. If he's reporting his income, assuming he has other jobs, he doesn't care that I gave him a 1099 because he made $15,000 because he worked $5,000 for somebody else. So getting a 1099 to somebody that's doing everything they need to do, I wouldn't care. I don't give me a 1099 if I'm reporting all the deposits in my bank account. I'm probably going to have more deposits than my 1099s anyway. So that's fine. But the people you buy materials, if I'm buying materials from Val and from his business that's in the business of materials, I'd say no 1099s. If he's a contractor buddy of mine and I buy $1,000 of wood from him, plus I do hire him for contracting, I'd probably just give him the 1099 for the total amount. If it was a major amount, we might discuss it, but arguably if it was Val and not a business, they would say that was I hiring him for contracting or actually buying wood and then also hiring him for contracting. So debating over the number, I'd say do both of them. Someone else asked about flippers and self-employment taxes. So flippers, if you're flipping houses, that's what I referred to as Schedule C, ordinary income. If you're flipping one house, a Schedule C, I would say there's no salary in that case. But let's say you're flipping 10 houses and you own an S corporation, and I do 100,000 a year in profit. That 100,000 on my Schedule C would be subject to income tax and self-employment, 15% for self-employment. That S Corp that does 100,000 in activity, is not subject to self-employment. But then if you don't do any what's called reasonable compensation and say that 100,000 is all owner's distribution, effectively a dividend, IRS will say no, it's effectively all salary and they'll back charge you. So usually I work with clients on what's a reasonable compensation. is at 40,000. So 40,000 would be subject to the equivalent of self-employment, meaning the Social Security and Medicare, but the additional 60 would be insulated from that. Again, those numbers, it's going to be a case-by-case basis. What's reasonable compensation is going to be something myself and the client would determine. Usually owners put themselves on the payroll. If it's a one-man show, that a lot of them will pull distributions throughout the year, and at the end of the year, true everything up with one year-end bonus check. So let's say I take 100,000 out of my S corporation, December 31st, I do one bonus check for that difference, or for a 40,000, the net amount I would reduce my distribution by. Um, so you don't necessarily have to be on a weekly or bi-weekly payroll. And I err on any of you that are going to start a business and register for an EIN number. I usually do not apply for payroll taxes or get registered for them unless you're actually going to hire employees. If you're just checking the boxes to get started, payroll taxes are the biggest pain. Even not reporting those forms are the biggest pain to get cleared up. And right now, a lot of the tax relief has provided employers an opportunity to defer. So let's say I work for a contractor, I have my withholding and my Social Security and Medicare to stimulate the economy. They've allowed them to defer their contributions. And if they can defer that, that's fine. But think about it. You've withheld that money. You owe it to the government. If you go spend it on a bad flip, you could end up multiplying your problems, and payroll taxes are the worst to get involved with. Those of you that have payroll, I say hire a payroll company. I don't want to do your payroll. There's professional payroll companies out there. It's worth it because I can tell you that's the fastest way. I've seen small businesses. A local investor came to me, had a $7,500 payroll, but didn't file all the forms after they got rid of the employee. $10,000 in penalties later and a couple garnishments in their bank account. Came to me, had another $10,000 in penalty and couldn't figure it out. I said, well, you didn't file all the forms you were required. You should have closed the account. Well, I stopped payroll and I just stopped paying them, but they never closed it. It's the hardest thing to close once you start. So those of you, don't check those boxes until you actually get payroll. And those of you that need payroll or whatever, I can refer a payroll company to you, but I prefer not to do it myself. I don't want to deal with it. Then another question I have, and then those of you that have LLCs and S corporation tax returns are due March 15th, not April 15th. So a call I get quite often is March 30th. Someone calls me, wants an extension for a tax return and says, oh yeah, my wife and I created 3 LLCs this year. I need those extended. I'm already past the extension date. There's nothing I can do. We will file the return. You will get a tax notice on there. There will be a penalty. I will write a letter. You will get out of the letter. It's going to be about a 6 to 9 month process. The IRS is slow. It was 6 to 9 months a year ago before COVID. Right now, I have letters that I'm still dealing with from the summertime to get those waived that they haven't even opened yet. I do have a few clients that have called on their own after about 4 hours got through and actually got it waived, and it's not a big deal. The client that owed $800 and got it waived, that's fine. I have another client that him and his 4 kids and his wife got into it. The penalty is $200 per month per partner if you don't file the extension. So when we file by September 15th, you get this nasty letter that says you owe $6,000 that I generally tell you about. You're not, it's nothing I did, and I'll generally get you out of the first one. But it's just a big shock when you get that. So any of you, when you do create a new LLC or S Corp, whether you work with me or your other tax advisor, let them know so that they can have it on their list of companies to extend. Single members don't have to be extended, but let them know. Don't go to them April 1st and tell them you need an extension for stuff that was due March 15th. I throw that out there, not to insult anybody, but I hear that all the time. And it's not a big deal, but when you get that big IRS letter and the intent to levy, those are nasty letters, and can they give you that uneasy stomach feeling? So so somebody had a question, if I have a builder's license, can I charge my own rehab labor costs? I think the question is, effectively, I'm doing a rehab and I would hire somebody for $10,000, but can I charge my rehab 10,000? You can use your sweat equity to do your um, flip, but unless you're charging your flip entity $10,000 and recognizing it on your building entity, that's really just sweat equity. So if you do the work on a deal, could you have a building company that could you have a building company that is doing the construction for deals that myself and, let's say, Val owns? We both are partners in investing on a deal, but I also have a construction company. I should be entitled to charge a profit. The key to a good partnership, I would want to discuss the profit I'm charging with my partner, though. Um, I mean, the better you can work, especially if you have partners, then somebody was saying materials used in sweat equity being tax deductible. Well, if they're materials you purchased, they would be tax deductible. If it's that I'm tearing off part of my house and I'm renovating my house and I've got some leftover bathtubs and some leftover cabinets and I'm going to go put them in my flip or my rental, they're effectively um, not going to have any basis to me, because my house has its basis, and you can get into all these basis adjustments, but effectively they would not have basis to add value to my rental. If I just took cabinets out of, or I had cabinets that I find from my parents are renovating their kitchen, I take their cabinets and put them in my rental property. Um, I don't get like a step up in that because I didn't buy them. So generally, effectively, it'll increase my value, but it won't um, give me any additional depreciation. Um, so then somebody said that they do LLC's income as pass through, I think Schedule C. Um, and I would not necessarily say that it's not advised, because again, the individual asking the question, are there medical savings accounts, health, retirement plans? Schedule C income opens up opportunities for other retirement plans. So, I mean, purely on the standpoint of self-employment tax, there might be other strategies. On a standpoint of maximizing your profit, maximizing retirement savings, there's other strategies, and it starts to get, it's depending on factors. And are we making $10,000, 100,000, or 400,000? Those run into different areas, and somebody making 400,000 on a Schedule C might be taking full advantage of a solo 401k or a SUP, and putting in upwards of $50,000 into those plans. Somebody on a S Corp might only be eligible for a 19,500 401k plan. So again, it depends what's out there and the longer term, what other strategies are there. So, I mean, on one answer, it might cost, but is there IRAs that I want to maximize dollars there? So, um, um, yes and no. um, then, but another question here. Um, what tips would give people from short term? Okay, so so the question was, what tips would I give people for short-term rentals? And short-term rentals are, there's a lot of issues open with the IRS right now on the short-term rentals. If I own a property and it's being rented on an Airbnb, I'm going to say that that's a rental activity and look at it that way. We're also seeing a lot of operators that are effectively renting from a real estate investor. I'm the host on the Airbnb side, and I'm marketing that um, out to the Airbnb world. So I'm going to take a real estate investor, get their deal under contract for a year, pay them maybe a premium rent. I'm going to fix it up, clean it, and I'm going to market that. And that's more of what's called like a host. I may not even own the real estate. I might just be arbitraging it between myself and somebody else, and that's really new territory. I think of that still as rental, and there hasn't been anything that I've seen yet come through. But the problem with that, and I can see they're going to tighten this up, they're really pushing, you're not a real estate investor at all. You're in the active business just like a hotel operator, and really that income should be on your Schedule C, not your Schedule E, subject to self-employment and ordinary income tax rate. So again, it's really developing with the Airbnb market, and the guy that owns the Airbnb and hires somebody or rents it to the host who's doing the Airbnb. Those are going to be in different positions, I think, when it's all said and done. I mean, no different than someone who owns the Marriott hotel and the actual operator. He might own real estate, but he's in the business of renting rooms and hospitality. He's got a restaurant, he's providing services, and he's cleaning the rooms. That's more of a business venture. He's got employees. So there's a lot out there. Depending on, if someone told me they had 100 Airbnbs, we'd really want to look closely. Are they a Schedule C business, and look at everything? If someone's got a couple, it's really going to be how they're operated. Do they own them and stuff? But definitely, I think things are going to change over the next year or so. I mean, we're going to see something. But then again, the IRS just came out with regulations on what determined real property on 1031 exchanges from the 2017 tax cuts, and they just had their final regulations a few weeks ago. So it took them almost 4 years to come up with regulations on that. There's a lot of things that haven't been finalized. So hopefully we'll get better guidance, but I don't really have an answer on which line that would go on. It'd be more of a case by case and working with my client. Any other questions? I think if anybody wants to send into the chat or chime in, I know looks like we're actually at 8:53. Appreciate everybody's time. I will be sending out everything to everybody, and I can send out the presentation and also the chat, and hope that helped. If anybody has any questions, again, feel free to reach out. Send any questions you have to tax@reitaxcpa.com. And again, everything I said is more in general nature. Hope it helps. And if your case is a little bit different, it might be worth exploring. Does that case apply to you? But appreciate everyone and your time this evening. Thank you. I'm going to save the chat so that I can. And then I'll keep everyone posted if I do this again, or if anybody has any topics that like to go over. I know some people talked about possibly bookkeeping or maybe something a little bit more. And again, if anybody doesn't want me to mail them on any updates, so anybody that's interested, here's the ways to contact me. I do offer this will actually take you to a link to my calendar.